Hey everyone, Logan Hertz with Hazeltine LLC. I have with me, as always, Peter Nelson of Nelson Insurance Advisors. Peter, how are you?
Living the dream, Logan. Living the dream.
So today I thought we'd explore a theme that I've talked about before, which is that formal financial training doesn't necessarily translate to understanding financial concepts in a way that makes sense for the average person, right? And I don't. This is not true just in finance. This is true across the board. So I spent many years in strategy consulting, working with people of all different stripes. Okay. And the people who had all of the qualifications weren't necessarily the people who came up with the best ideas. In fact, the best ideas often came from people who had no credentials and no experience. And the reason is because they were not locked into the groupthink. Okay. It's not to say credentials are bad or anything like that. It's just that, as you get experience and as you gain credentials and as you learn to do things a certain way, which works, you kind of get locked into that. And that's why it's good to have someone who is completely green and has no credentials and experience to come along and provide a fresh perspective, right? Um, and that's a lot of what I did as a consultant. I didn't have any like official qualifications at all. All I had was my brain, right? But the fact that we were outsiders was a huge advantage. I don't care what your company is or what your business is. When someone comes in as an outsider, they will see things that you do not see. They will see things from a perspective that you do not have, right? And so, as kind of a case in point, I thought we'd examine an exchange that I had with a commenter on this infinite banking hit piece that Chris Kirkpatrick and I responded to on his channel. And I had kind of an interesting exchange with him. And I thought we'd explore it a little bit as a case in point. I don't
Yeah,
know, Pierre, do you kind of agree with what I'm saying?
yeah, absolutely. You know, we that's what makes this, I think, still, even though maybe it's not as good as it once was, this country great is new ideas, right? People looking to take bold steps and shake things up. I mean, you just look at a guy like Elon Musk. Maybe I don't agree with everything that he talks about, but he's come up with some pretty brilliant ideas, you know? So that's what made us great in this country was innovation and new ideas. So
Yeah, I like to say I make my money by being the little boy who points out the emperor has no clothes. And that guy didn't have any credentials either, right? Okay, so let me share here. Let's take a look at this. All right. So this is from Responding to Infinite Banking Concept Blog Hit Piece, part 1 of 3. This is on Chris's channel. He posted all 3 of these. This is part 1. And so here I'm having an exchange with this guy, MDA 0214. I'm not sure who he is, right? But let me just read what he said. And of course, if you haven't seen our response to the infinite banking hit piece, you don't necessarily need to watch it for context of this video, but it might be helpful. So he says, I think both concepts are bad, especially for someone who wants to build. The fastest way to get to freedom is lowering expenses. So in your example, it wouldn't make sense to add an expense for a depreciating asset. And in his example, it wouldn't make sense to employ that much capital in a depreciating asset. The correct way would be to put the money into an asset that would give you cash flow to pay for the car. Both of you keep talking about opportunity costs, but completely ignoring the fact that the monthly payments over time is actually costing you more. So let me paraphrase. Okay. He's saying we shouldn't be adding an expense to buy a depreciating asset. So this is something that you get a lot from people who don't understand the infinite banking concept. They're saying, why would I go into debt to buy a depreciating asset? Or why would I get negative arbitrage? So, just as an example, let's say I take out a whole life policy, I'm earning 5% in the whole life policy, and I'm going to borrow against that policy at 6% to go and buy a depreciating asset like a car. To this guy, that sounds like a losing proposition until you ask the question, as compared to what? As compared to what? Right? we're assuming you're going to buy the car anyway, right? So yeah, buying depreciating assets is not going to make you rich. Nobody's saying that, but you need to buy some depreciating assets to live. You got to buy cars, you got to buy clothes, you got to buy furniture, right? That's just reality. So as long as you're going to make that purchase, what we're saying is make that purchase in the most efficient manner. I gave this example before. Okay. I'm going to give an example, Peter, where it makes sense to buy a depreciating asset, let's say furniture, and be charged 21% interest while only earning 2% on that purchase, right? Now, to this guy, that sounds insane. You're buying a depreciating asset and you're losing 19%, right? Sometimes some of these numbers people oversimplify it, okay? So let's say I'm going to buy furniture. I'm going to buy $5,000 worth of furniture. I'm going to buy it anyway, right? I bought a new home. I'm going to decorate it, okay? So I'm going to buy the furniture anyway. So yes, it's a depreciating asset, but you're going to buy it anyway. You're not buying it as an investment, okay? So I would say put that purchase on a rewards earning credit card that gives you 2% cash back. Let's say the interest rate on that credit card is 21%. So you're being charged 21% compound interest. Okay. But you're going to pay the credit card off on time, right? So as a result, the interest you actually end up paying is zero. And the net is you take that $5,000 you're going to spend anyway, and now you get 2% back. So as long as you're going to spend the 5,000, why not get 2% back, right? Make sense, Peter?
Yep.
So I think this guy, by the way, is a fund manager that will come out later. And I think they just get locked into this return on investment mantra, and it colors everything that they look at. And so not only can they not see it, their training kind of, I'm not talking about this guy in particular, but just abstracting in general, creates the credentials and experience that they have creates this intellectual arrogance that doesn't allow them to learn anything anymore, right? Because now they view themselves as being the experts, and they're now closed off to any new information or new way of thinking about things, right, Peter?
Yeah. No, I think that's exactly it. And let's face it, they're locked in, they're making money one way, and they're going to drink the Kool-Aid and they're going to drink it a lot, right? So if I was in his shoes, I might do the same thing. I mean, it just, Logan, we just talked about this before we started here. You had just talked about this in a previous video that we did. You were talking about a fund manager, right? So, I mean,
Yep. Yep. So here's my response. So we're not suggesting that you add an expense for a depreciating asset. What we're suggesting is that since you must buy some depreciating assets to live, such as a car, make that purchase in the most efficient manner. Again, the question is always as compared to what? Okay, then here's the response. I understand. Notice how that's always what they start with. I understand. Because his goal is not to learn any new information. His goal is to demonstrate he knows and win an argument, right? As opposed to my goal, which is just to find the truth. I'm not trying to get into an intellectual, contest with anyone and prove that I'm smarter or I know. I don't care. If I get educated, great. That's a good thing. If I learn something, that's good, right? I'm not trying to even get into an argument, let alone win one. I'm just trying to make sure that the message is coming across clearly. So if someone misunderstands the message, I want to make sure that the message is clear. But this guy views it always as an intellectual pissing contest, basically, right? And he wants to win it. I don't think that way. Okay, I understand. Well, no, you don't. That's clear. But anyway, the what he should put is, I'm a fund manager, so I know everything, right? Okay, I understand, and I would still say that's a bad idea. If it's a need, it would be better to pay cash. Someone would be losing more by taking on a loan and paying interest on something that is losing value by the day. It will be bad money management. That money is already going down the drain. No point in adding interest. It's like someone who's trading stocks adding to a loser. Better to cut the loss early. LOL, even Robert Kiyosaki, someone who strongly suggests using debt, pay off his cars in full. It's accountant 101. Okay.
can I just add something real quick because I'm thinking about it?
Yeah.
that line, it says that money is already going down the drain.
Mhm.
No, I don't want the money to go down the drain. That's why I'm going to purchase that car through a cash value life insurance policy. And that's the part that he doesn't get.
Mhm.
He
Mhm.
thinks it has to go down the drain. No, it doesn't.
Good point. Excellent point, Peter. Excellent point, Peter. Yeah. So your money is now not going down the drain. It's still earning for you in your whole life policy, whereas it would have gone down the drain if you had paid cash, right? And the other problem, he says you're adding interest. Like this is an added cost. This is another mistake people make. They're like, well, I could just pay cash. So why would I add interest? I'm buying a depreciating asset. I'm losing the money I'm paying in cash. I don't want to add another expense and interest. No, you're paying interest anyway. It's called opportunity cost.
Exactly.
When you pay cash, the cost to you is not just the cash you paid, it's the cash you paid plus the interest you would have earned had you saved that cash, right? So if you take out a loan, yeah, you're paying interest, but now you're also able to earn on that money too. So I'm not even talking about infinite banking here. I'm saying if you finance the purchase of that car, let's say you have enough cash to buy the car, right? In a lot of cases, it might make sense to finance it anyway from a conventional bank because now I can earn on that cash that would have been gone instead. And yes, I'm paying interest as I pay that loan off, but meanwhile, I can still keep earning on the interest on that cash that I now didn't spend, right? So you can see examples online where it'll show you, assuming the interest rate is the same, it's a wash, whether you pay cash or whether you use a loan. Assuming the interest rate is the same, it's a wash, right? But what you're pointing out, Peter, is if you use a policy loan from whole life, you didn't throw any money away because you didn't spend your money. You spent the insurance company's money. Your money is still safely earning for you inside your policy. So now no money got thrown away. And no, the interest that's charged on the policy loan is not an added cost. That's a cost you're paying anyway. And
Exactly.
here's one of the intangible benefits of using a policy loan. When you pay cash, that opportunity cost is a hidden cost. And we don't manage things that we can't see very well, right? When you pay $25,000 for a car in cash, you see the $25,000 that leaves your personal economy. You don't see what could I have earned on that $25,000 compounded from now until the day I die, right? That's a pretty big number. But because you don't see it, you don't manage it very well. Okay. Whereas when you use a policy loan against a whole life policy, of course, you have the advantage that your $25,000 is still earning for you inside the policy. And that hidden cost now becomes a visible cost. You can see the interest you're being charged on the policy loan, and that's a good thing because now you're going to manage it a lot better. So, no, it's not an added cost. What you did was you took an invisible cost that is difficult to manage and turned it into a visible cost that is now much easier to manage.
I like that. That's what I was writing down.
Thank you. Thank you. Okay. All right. Yeah, I learned that a lot in consulting too. The things that you see and measure tend to improve. Usually it's the things that you're not seeing and measuring that are the problem.
Yeah, and I don't even think I talk about that enough, what you just said there. And like I said, that was
Yeah, and what is everyone measuring, Peter? Return on investment, right?
right.
That's what they're always
And
measuring.
and what
Okay.
you just said is they don't think about it because that opportunity cost is a hidden cost, right?
Right,
But
right,
yet they can pick on it in the policy loan because they can see it.
right, right.
Just if you get anything from this video right there, I think would be just that's an amazing point to get out of this video right there. So continue.
Okay. And so then I respond, you're not adding interest. If you pay cash, you're still paying interest. It's called opportunity cost. So whether you take out a loan or pay cash, you're paying interest. It's a wash. The difference is when you use a policy loan against whole life, you are still earning on the same principal balance. The fallacy you're falling into is thinking that if you pay cash, you avoid paying interest. That is false. And I probably shouldn't have said this just because someone like this, I think, has a pretty big ego and they think they know everything. So you got to be more diplomatic than this. You can't tell them they're falling into a fallacy or else they just try and win the argument and say, no, I'm right. No, 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 no. I should have found a more diplomatic way to say that. It would have probably been more productive, because then it just devolves into an argument, and then no one is ever going to change their mind or learn anything. Then it just becomes about, who's right and who's wrong. Well, if I get proven wrong, I'm kind of happy because I learned something, right? I'm happy to learn something. Okay. Now here's what he says. The part that you're missing is that you're paying double. So no, it's not a wash. You're paying interest on something that is going down in value. The opportunity isn't lost because you don't know where the cash came from. If it's coming from one saving, yes, they would be losing. But if they're pulling cash from an investment like rental income or dividends, no, there's no opportunity lost. Okay, so again, that's false. There's always an opportunity cost. Okay, it doesn't matter where the money comes from. You always could have earned on that money. So if you're pulling cash from an investment like rental income, okay, if you didn't spend the rental income on the car, you could have earned on the rental income, right? So there's always an opportunity cost. You cannot avoid it. You cannot avoid it. Okay. The
So it
initial
kind of
investment is,
it kind of goes back to the old adage, you're damned if you do, damned if you don't kind of deal.
yeah. And the question is always is as compared to what? As compared to what, right? As compared to what? So when we're doing these examples, we're always looking at it in a limited sense, right? So we have to look at it within the confines of what we're talking about, right? So he says the initial investment is still there working. If it's someone without investment, I still wouldn't recommend taking out a loan. The opportunity loss is them paying the banks. It would be better for someone starting to buy a good running used car. I just have to point out this guy's grammar and spelling is not very good. Okay. Buy, yeah, that's B-U-Y. And yeah, anyway. With the cash flow from not paying a bank, they can save that in whole life, then borrow against it to invest. Or they can just invest. But you actually lose way more buying a car with a loan. It's the one thing that even Robert Kiyosaki say you should pay cash for. It's basic accountant and understanding cash flow. Well, maybe, but you don't understand basic grammar, apparently. So again, no, you're not paying double, right? What he's saying is you're paying double because you're paying interest on that loan and you're losing because the car is depreciating. Well, the car is going to depreciate anyway, right? I mean, that's not adding anything. You're going to buy the car anyway. Yes, the car is a depreciating asset, but again, this is not an investment. We're not making an investment. We're just saying you're going to buy the car, so buy it in the most efficient, effective manner. And opportunity cost is always there. It doesn't matter where you pull the money from. If you pull it from investment income, from a rental property, it doesn't matter. The opportunity cost on that particular money is always there, right?
And I'm not against, by the way, buying a used car. Okay. You can use a cash value life insurance policy to buy a used car.
And again, he says he pretends like he understands opportunity cost, then he calls it opportunity loss. Well, I don't know what that is. That's not what we're talking about. But then clearly shows that he doesn't, because he keeps insisting that if you're going to buy a depreciating asset, you should pay cash always, because then you avoid paying interest. Well, again, if you understand opportunity cost, you know that's false. Okay. You can't avoid it. You can't avoid paying interest. You're always paying interest, either, by taking out a loan and paying interest to a third party, or by foregoing the interest you could have earned. There's no avoiding it, right? So he's saying if you're going to buy depreciating asset, you should always pay cash, because then you avoid paying interest. No, you're going to pay interest either way. You got to look at it holistically. And depending on your situation, it might be better to pay cash, or it might be better to finance that car, right? Especially like in the wake of COVID, when you could get, loans at ridiculously low interest rates. Why would you pay cash when you could get such an attractive financing solution, right?
And by the way, if you own a business, then you want to look into leasing vehicles, and you can talk to your accountant about that. So it depends on the situation, right? Every situation could be different. Like if I buy my next used vehicle, I guarantee I'm leasing it.
Yep. So again, the question, as always, is as compared to what? As compared to what, right? Okay. Now here's my response. Thanks for commenting and engaging. No, you're not paying double. It's clear you don't understand opportunity cost, and there's not space here to explain that to you, so I'll leave it at that. So again, I should have been more diplomatic about how I said this, because again, he's going to respond by his response is always going to be nuh-uh, nuh-uh, right? Because then egos get involved, and I should have been more diplomatic about how I said
Logan,
that.
stops being so mean.
I know. But it's clear he doesn't understand opportunity cost, but he's got too much financial training to admit that he doesn't understand something basic. Kind of reminds me of I know someone who does a lot of math tutoring for high school algebra, I think it is. And I asked this tutor, like, what are some of the typical issues that you see? And they're always like, it's never a problem with algebra. It's a problem with something in pre-algebra or a previous concept that they missed and that they don't understand. And since algebra is now building on that body of knowledge, it just compounds the misunderstanding, right? So same thing here. There's a basic financial principle that he doesn't understand, right? But because of all of his training, he thinks he understands everything, right? And his goal here is to win an argument. My goal is just to clarify the message, right? And try and find the truth. If I get proven wrong, great, I learned something. I'm trying not to put my ego on the line, but I should have been more diplomatic, right? Okay, so here's what he says.
I don't think this guy, by the way, is, I mean, his comments aren't, it's just a different, he doesn't get what we're trying to say here, but at the same time, he doesn't seem to be, the comments aren't super bad, right? In a way, they're,
but notice, that's always the first word. I understand, right? So he always starts with I. I understand. So his point is shows I know what I'm talking about. And my response is more like, hey, thanks for commenting. That's how I start mine. I don't start with talking about me, right? I don't use that pronoun. And then his response again, I understand completely, right? So again, his goal is to show he knows and he's going to win an argument, right? I don't care who has the better financial credentials or who understands or whatever, right? Clearly he doesn't understand, but that's his goal, to show that he understands. Sort of like the 2-year-old who wants to tie his own shoes rather than just letting the parent do it. So I understand completely. I actively manage a fund. I look at financial statements all day. Right? Again, keeps using that word. I, me. Okay. So again, this is just him basically massaging his ego, right? And showing that he knows and he has the credentials. Okay, you actively manage a fund. But that doesn't mean that you know everything. You look at financial statements all day. That doesn't mean you know anything about opportunity cost, right? So I understand completely. I actively manage a fund. I look at financial statements all day. Again, the implication is because he manages a fund and looks at financial statements all day, therefore he's right and I'm wrong. Well, whenever someone brings up credentials in place of an argument, they don't know what they're talking about, right? If they did, they wouldn't have to bring up their credentials. They wouldn't have to bring up their years of experience. They could just lay out a coherent argument and it would stand on its own. It doesn't matter who's making the argument, whether they have credentials or not. You can just look at the argument itself. Again, to your point, Peter, most of the people who have made breakthroughs in different fields are people who are outsiders, right? It wasn't people with a lot of credentials, because those people, kind of get locked into a certain way of thinking, right?
yeah, I mean, look at Thomas Edison. How many times did that guy fail before he did something? But he kept on throwing wild ideas out there until one actually worked, right?
Yeah, how many times did people like him get lectured by those who did have the experience and credentials, right? And of course, they were just engaged in special pleading and protecting some interest that they had, or maybe just protecting their own egos, whereas the outsiders ended up being proven correct, right?
Right.
So no, financial training by itself doesn't mean anything. Okay. Good common sense goes a long way.
And
right?
be bold. Be bold. Never,
Okay. There's no math or anything to substantiate your argument. Again, this is not a math argument. We're talking about a concept, opportunity cost, right? There's no math in it. Okay. The application of it might involve some arithmetic, not math, right? But opportunity cost is a concept. You don't have to put numbers to it to understand it, right? For real assets, it makes perfect sense to borrow against your policy. So again, he's losing sight of as compared to what? What he's saying is you should only borrow against your policy to buy something that is an appreciating asset or something that gives you cash flow, right? The
Well,
assumption again is that if you borrow to buy a depreciating asset, that borrowing adds an additional cost, interest. So instead, you should pay cash. No, that interest is not an additional cost, right?
well, at least we have him on our side there. He's at least right. That's why I look at it. He can't be that bad. He says it makes perfect sense to borrow against your policy. Okay,
Yeah, yeah,
I can. We can work with this.
yeah. I know. Yeah.
So, Mr. Fund Manager, even though we might be a little critical of you right now, we still love you. Okay.
No, he is right on that. Like, I think the question is as compared to what, right? You know,
Yeah.
depending on what options you have, it might not make sense to borrow against your policy to buy a real asset, right? You might have a better financing option. I don't know. You know. Okay. So then I just said I was trying to, cut it short. So I just said, you're a fund manager. Well, that explains a lot, right? Because once he said he's a fund manager, I'm like, okay, I know this is never going to end, right? This is never going to end. He's just going to keep coming back with his credentials and, hey, I'm a fund manager, so you should shut up and listen to me. Well, that explains a lot. Congratulations on being a fund manager. I'm assuming you make a lot of money, and that's great. Thanks again for your engagement, right? So I knew, that was the only way to sort of end the conversation. And I want to say too, like, I do mean this. Like, I hope you make a lot of money and congratulations on being a fund manager. Like, I do appreciate your success and I wish you more of it. Right.
And it's not an easy, it's not an easy job. There is a lot of pressure and stuff like that on the job. So, and it sounds
Yeah.
like this guy is an advocate of cash value life insurance. So
Yep.
I do give him kudos for that. I mean, that's
Yep.
awesome. I think more people on Wall Street, more fund managers, stuff like that should be talking about going back to the Ernst & Young report, integrating cash value life insurance into your portfolio. It will always make the portfolio better, or more effective and efficient. Shouldn't say better because what is better, right? But anyways.
Yeah. It sounds like he is acknowledging that cash value life insurance is a good asset and can be used as a good financing tool, at least if you're buying appreciating assets or investments or cash flowing assets. So we can agree on that. Certainly, absolutely.
Yeah. And actually, a guy like that would be actually really interesting to do a video with.
Yeah. I think that the challenge I would have with someone like that is we've got to get away from this return on investment metric. So he mentioned Robert Kiyosaki a couple of times. I think Robert Kiyosaki would agree. If you're investing for capital appreciation, that's a chance risky. You should instead be investing for cash flow, right? Cash flow. But this guy being a fund manager, of course, it's all about return on investment for the fund managers, right? That's what it's all about. Because his job is not to provide income to the customers of his fund, right? But
Well, I mean,
rather to attract as much assets under management as possible. So he doesn't want to give them money. He wants to take money away from them and keep it locked in his fund for as long as possible, right? It's the 4 rules of financial institutions, right? Rule 1, give us your money. Rule 2, give it to us on an ongoing systematic basis. Rule 3, let us keep it for as long as possible. And rule 4, if and when we give it back to you, we're going to give it back to you for as slowly as possible, if at all, right? So this return on investment metric helps to accomplish all those things because people will then lock their money up in hopes of getting some return. And then they're afraid of withdrawing it for the fear of missing out on that potential return, right?
yeah. I mean, unless, I guess you could put one little asterisk there, Logan, is if he would be handling a fund that maybe is an equity and income or a rising dividends fund that was actually more built, like one of the most common is the Franklin Income Fund. Okay, that's more income based. Now we could argue whether that's the most effective and efficient way to produce income, but it's
Mhm.
an income based fund. So maybe he was on that side.
But then don't they tell you to keep reinvesting those dividends so you get more compounding? Isn't that what they tell you to do, right?
Well, I mean, if you know,
And
if
again, there is some
you can,
logic to it, right? If there weren't some logic to it, no one would sign up for it.
right? I mean, it all depends, I guess, on the situation. So I just wanted to throw a disclaimer. You're probably right on this, but there is, you know, just trying to
My
be.
experience has been, and this is just me, my experience is very limited. So granted, that the best prospects for the infinite banking concept are people who have no financial training. Right. And it's not because they're naive morons, it's because they're not locked into that group thing. Right.
Right. Yeah,
I found the same thing in my consulting experience. The people who bring the best ideas to the table are usually people who have no experience or credentials because they're looking at it from a fresh perspective and they come up with great out of the box ideas. Not to say experience and credentials are bad. Of course, they're good, right? The best teams are a good mix of personalities. And I think the best teams are also a good mix of experience. You do want someone who's got a ton of experience. That's very valuable, right? You want someone who has those credentials. That's very valuable, especially when you're trying to sell something. Because someone who has no experience, no one's going to buy from him. Like, why would you, right? But the guy who's got a lot of experience, he probably has very deep relationships, right? And he knows how to talk the language of the people in the industry. So the person who's completely green will have a great idea, but they might not know how to communicate it to these people in a way that makes sense to them. Whereas the guy with the experience will know how to translate that into language that those people will understand.
Yep. Yeah. And I once again, it goes back to, I think this one word, control, right? What we're saying here is, do you want to be control, or do you want to hand $25,000 of cash to a bank? Frankly, me, I'd rather retain the money, right?
Yep. Yep.
Control
Yep.
it.
The
So
more I go in this business, the more I value the intangible benefits of the strategies we're talking about over the tangible benefits. How about the psychological benefit of having certainty? How about the peace of mind that comes from knowing you have that permanent death benefit protection and your plan cannot fail? It will come to completion, right? To your point, having control over the banking function rather than having to go and ask permission from a bank, right?
right. I mean, I know of someone recently, um, they bought a house and they threw down like $250,000. And I'm sorry. I was like, knowing that they also need income, by the way, right now, and because they're
Mhm.
in retirement, and they threw down $250,000. There is no way in heck. And I told them that. I'm sorry, I don't agree with this. They did it anyways. But think about that. Anyways,
Yep. Yep.
it's
Could
a
they buy
mindset.
it? Could they have bought it with a reverse mortgage, Peter?
Yeah. Oh, absolutely.
Might have been a better idea.
And I didn't even get to that part because it was in a very in a part of the country where houses don't stay for sale very long. And it was a very nice house and a nice
Mm,
development, but
mm,
they just, they wanted to jump on it fast, threw
yep,
down a pile of money, and I'm
yep,
like, "Oh my gosh, if we," and I'm not going to do the math with them, but the math is not going to be nice to them about the amount of income that could have generated, oh, you know?
yep, yep. Well, when it comes time to, you know, refinance it, maybe you can do a reverse mortgage on it and get access to some of that capital.
Yeah.
Or a first lien HELOC, depending on what their ages are, that might be a good solution or not. Just depends.
No, I think they're at the point where a reverse mortgage would make more sense.
Make
And
more sense. Yep.
of course, that's a whole new concept that a lot of people have a tough time, you know.
Yep. Yep. Yep.
Anyways,
Like most of what we do. Okay, Peter, thanks so much for your time. Really appreciate it. God bless everyone.
all right. God bless. Godspeed.